Hi, welcome to another financial market update for the month of February 2013. I'm Tom Elliott and coming to you here from the studios of radio station 3AW. Well, the Reserve Bank decided to leave interest rates on hold during February. Of course, they didn't meet in January. Interest rates, or at least the official cash rate, are now 3%. The Reserve Bank did admit in its commentary that it could cut rates further, and indeed one of the RBA board members, Heather Ridout, said as much before the Reserve Bank had actually made its formal decision. So I still maintain my view that there's probably at most 50 basis points to come, 0.5% in terms of official rates coming down. As we know, when rates do come down, the big banks sometimes pass on all of the cut, at other times maybe only 2/3 of it. I think if official rates fall another 50 basis points, I reckon the big banks will pass on around 40 basis points or 80%. Having said that, if you look at fixed rate home loans at the moment, they are in many cases pricing in a cut of 0.75%. So I must say my firm opinion on that is that fixed rate home loans, particularly over 3 to 5 years, look very good value at the moment. Well, the federal election has also been called, and indeed Julia Gillard has decided to give us the longest election campaign in Australian political history. Only time will tell whether or not this is a smart move for her. On one hand, we now know the date of the federal election, and that removes a level of uncertainty, and that's good for business. I mean, businesses just like to know when things will happen, and probably it could be good for home buyers too, because again, you know when the federal election is, you don't have to lie awake at night, if indeed you do such a thing, worrying about it. So overall, I don't think the election is a big issue. Just get ready for a lot of boring articles about politics in our daily newspapers. The share market over the past couple of months has been very strong. The ASX has broken out of its trading range. It was around about 3,950 points to sort of 4,450. It went up and down between those two levels. Well, now it's over 4,900 points, so well and truly above that, more than 10% above its trading range for the past 18 months. Why the share market has gone up, it's pretty simple really. The US dealt with the fiscal cliff by simply agreeing to borrow more money. Eventually that will be a problem for America, but the US has increased its debt ceiling, I believe, almost 60 times since the end of World War II. So there's no sign that that pattern of behaviour of borrowing more and then spending will change. Other things that have helped, the US economy is finally starting to respond. US house prices appear to be turning up. US economic activity is certainly trending up. Unemployment is going down. The US is awash with cheap energy in the form of shale gas, and all this is helping a healthy recovery in the American economy. Europe, although still a basket case, is showing scattered signs of improvement. The German economy in particular is doing well. And of course here in Australia we are still very, very lucky. We're on the doorstep of China, and China, whose growth, albeit has slowed, is still growing, and that's good for our market and good for our economy. The low interest rates that I mentioned earlier have led to a revival of income-producing shares on the Australian market. Telstra's been very strong, the bank stocks have been strong, infrastructure stocks like SP AusNet and Transurban also doing very, very well. We are coming up to reporting season, however, and as always, corporate profitability will soon be focused upon by analysts and investors alike. So the Australian economy, well, a bit of a mixed bag right now. I've been to some briefings recently. Some say it's full steam ahead, away we go, and in fact certain economists are now suggesting that interest rates will not be cut any further and could even in a year or so start to rise again. However, I'm of the view that the Australian economy is actually going to slow just a little bit this year. I think unemployment might go from around 5.4% up to 5.7, 5.8, maybe as high as 6%. Hence my call that interest rates might have to go down 0.5%. I also think that at some stage, if rates are cut further, the $A eventually has to come off the boil. It's still trading around 104 US cents, historically very, very high. If the Americans begin to sort themselves out, then I do think that the US dollar will gradually appreciate. And of course, a lower Australian dollar, while bad for travellers and so forth, is good for our real estate market because it means overseas buyers can come and more easily afford Australian houses, and good for our export and rural sectors. So unless you're a traveller or an internet shopper, we do want a lower Australian dollar. What does all this mean for local property? Well, Melbourne has been a bit of a laggard over the past 3 to 6 months in terms of house price appreciation, whereas in places like Sydney and Perth there have been solid, albeit single-digit gains in house prices. Melbourne shows price rises of up to say 2%. Some indices suggest Melbourne prices have fallen -1% to -2%. So not a lot of movement there. Of course, lower interest rates and the continued high levels of immigration should help spark a bit of a revival in the property market this year. And as always, there's anecdotal evidence around the place that quality properties are starting to attract premium prices, something that wasn't the case about a year ago. Finally, the banks still want to lend. In fact, they desperately want to lend because credit growth overall has pretty much come to a standstill here in Australia. So you might be very, very surprised at just how much money you could borrow, sensibly of course, if you want to fund the purchase of a new home. All right, well, I'll look forward to your company again next month, and I'm pretty strong on my prediction that I reckon the property market will be better in 2013 than it was in 2012.